All right. I want to say welcome everyone to today's webinar. If you are here for the first time and hearing Brett for the first time, you are definitely in for a treat today. I'm super excited. Brett, I met you probably maybe 3 years ago at one of the DLP conferences, and we were really inspired by the message you were putting out there, trying to essentially help investors save on taxes. So today Brett's gonna talk about something that maybe a lot of people haven't heard of before. If you're a passive investor, which is I'm assuming you are because you're here and you've never heard of this strategy before and some of the things Brett's going to talk about, I highly recommend you listen, highly recommend you pay attention. This recording will be available through Brett's network, through my network. So circle back with Brett, get with his team, get on a call and see if he can add some value to you. But if it's your first time here, I want to say welcome. My name is Brian Alfaro. I'm the Director of Investor Relations here at Headway Capital. And we do these webinars on a monthly basis, and we try to invite awesome speakers like Brett to come add value to you, educate you on how you can maximize your income and ultimately achieve your retirement goals, right? That's the goal that we're all chasing is we want to be retired. We want to live a comfortable life when we're retired. And ultimately we want to keep more of our money and not pay the tax man. So I'm excited that everyone is here today. Just some quick housekeeping on my side. This obviously is for educational purposes. Correct me if I'm wrong, but I'm pretty sure Brett's not a CPA or an attorney, so you should always consult your CPA and attorney, and of course your financial planners before you take any strategies here. We're just here to educate and add value to you. And a little bit about us. If it's your first time here joining us here at Headway, I want to say welcome again. We do these webinars on a monthly basis. So if it's your first time here, I want to say welcome. If you are a repeat visitor, I want to say thanks for coming back. We appreciate you tuning in. If you're listening to this recording after the fact, again, appreciate you listening. Headway Capital, we are a multifamily private real estate investment firm. And we've really started our firm for a big reason that Brett's going to talk about today is our founder and CEO, Sid and Anam, they had a big tax problem. They own 30, 40 single family houses, and the tax man came coming. So Sid decided to launch his passive investing business and eventually started inviting investors in back in 2017, 2018. And we've been growing ever since. So we try to find best in class passive investment opportunities in the multifamily space here in Texas with a big focus on Houston. We're owner operators. We own and operate all of our own deals. And we obviously have lots of experience doing that now over the past almost 8 years, which is really exciting. I'm a director of investor relations, so I talk to all of our awesome, amazing passive investors that decide to partner with us and trust us with their hard-earned capital. So if you haven't spoken to me, you haven't scheduled a call with me, that is step number one. If you want to get on our investor list and you want to get access to one of our open investment opportunities that we're trying to put out here on a quarterly basis, get on a call with me. That way we can make sure you're qualified, you get accredited, and you gain access to our investment opportunities so that when the time comes, you're ready to rock and roll. And then we've got Mr. Umar Nakvi, who's not here today, but he's our CFO. He's the numbers guy. He's the Excel spreadsheet guy that makes the whole business go. So a little bit about us, almost $500 million of assets under management, 3,000 units, give or take in the portfolio. And we have over 500 investors that have invested with us before, and really excited to share some of these testimonials here on the screen. So case studies. These are some of the assets that we try to buy. Got a couple A minus assets here, and then a C plus B minus assets here at Watermill on here all in the Houston area. And last year, 2024 was a okay year for us. We bought 2 deals. Our goal is always to buy 2 to 3 deals a year. And we're here in May, and we haven't gotten anything under contract quite yet. But I will say we're working pretty hard, and also working hard to make sure all of our assets in our portfolio are stabilized, because that's always really important to us too, is taking care of the assets that we already own. So with all that being said, I want to start to transition over to you, Brett. Today, Brett is going to talk about how to multiply your freedom and your impact with a capital gains tax exit plan. And this is not something that a lot of people really think about, I think, early on in their investing career. I think, I'm 36 now. I think when I heard you, Brett, it's like 33, 34. And you don't really think about taxes until they become a problem, right? That's kind of like, it's a good place to be in, because people call you when they probably are doing retirement planning and maybe they have a tax problem, right? A lot of people call you because they're looking at 1031s and their clock is running out. There's all these different strategies. So I'm excited to hear this topic today and to tell us a little bit about, how we can obviously grow our freedom, but the impact is really important too. That's something that I'm really curious about, because having money is great. Not paying Uncle Sam and keeping more in our pocket is great, but what type of impact can we have as well? So with all that being said, I want to turn it over to you and want to say thank you for being on the show, and it's all yours.
Thank you, Brian, and thank you, Sid, if you're listening to the recording or if you're live there somewhere. Appreciate the opportunity here. So we're going to dive right in. And again, we're going to multiply your freedom and impact today, hopefully with a couple strategies that can transform your life and or someone you know's life. And it's true, unlocking truly passive income is the outcome. And we're going to do that by building a capital gains tax exit plan, which if you can unlock the first, you can get more freedom, more impact. So for those, again, who are just meeting me for the first time, my name is Brett Swartz, and I'm the founder of Capital Gains Tax Solutions. This presentation, as Brian noted, you want to always bring in your CPA, your tax professional, to vet all the things we're talking about and to go through it with them in detail. And this message is for educational purposes only, and we encourage you to bring the independent professional advice to also make sure this can be a good fit for you potentially. Okay, so what is the big problem we're solving for? What's this capital gains tax? You know, they say there's two most expensive things in this world. The most expensive one is the things you don't know, and number two is taxes, right? So capital gains tax in particular can crush your wealth and limit your truly passive income potential. In fact, most of the owners we work with of businesses, Bitcoin, and real estate, before they find us, they're either limited with their time, they're limited with their stress, they're limited with just massive wealth, but maybe little or small amount of cash flow, low ROE, return on equity. So we're going to talk to you about how to build something that can truly transform your life again. So here's what we're talking about here, right? So up to 20, 30, 40, 50% on every massive exit has capital gains tax and depreciation recapture, depending where you're at. And it can be 40% of your proceeds, right? So would you like to have 100% of the proceeds or 60%? Okay, now this of course depends on what state you reside in, if there's depreciation that you've taken, but this is just a standard. Let's say you're in New York, New Jersey. If you're in California, we call it Taxifornia, you're looking at massive taxes, 20% federal, the state, and then Obamacare 3.8, depending on what you're selling, and the depreciation recapture. So this is what we're talking about, trying to solve for. So chances are, if you haven't solved for this yet or given it a lot of thought, you are feeling stressed about the massive capital gains tax bill looming over your sale. You perhaps are underconfident about how to reinvest and grow the wealth post-sale. And you're probably frustrated by the limited inflexible exit strategies available, especially if you wanted to, go with Sid and Brian and work into a multifamily, either syndication or a fund model. We're going to teach you how to do this tax deferred through our strategy here. And so you want more diversification or more liquidity. We're going to teach you that as well. You might be concerned about what's the right strategy for your wealth. You may be looking at the Delaware Statutory Trust or the 1031 exchange, or our strategy we're talking about today, the deferred sales trust. Which one is it right fit, and how do I know? And so we're going to talk about all that today. Now, having spent over 19 years in the industry, I would say please trust us, trust our team, that we know exactly what all of this feels like. In fact, we started out building real estate. I say we, my wife and I, once we got married, started to invest in real estate. But prior to that, before I was married, I was a young child. My parents would build real estate in the Bay Area, California. So building it, owning it, renting it, all of that. And then I went to Marcus and Millichap and started to study and practice multifamily brokerage. And so, and then the market crashed in '08, and we saw friends, family, and clients lose half of all of their wealth. And so we know what it feels like to feel trapped in a deal, to feel trapped in the 1031. We call it the shotgun wedding, 45 days to identify, 180 days to close, and or selling, wanting to sell your Bitcoin, wanting to sell your primary home, and not having a 1031 doesn't even work for that, right? And so we found that these are some of the things that you really want to focus on, that, priceless time, right? We want to focus on trading. You don't trade what's priceless for what's profitable, right? Too often we're taught to build a rich dad, poor dad, get into the fourth quadrant, but along the way, we're having profitable deals or profitable opportunities, but sometimes it's just taking up all of our time and energy we can spend with our family, the things that we want to be doing, other than owning and managing active real estate, or even the business. You're ready to retire and you've built it for so many years and you're ready for that next season of life. And we would say, don't trade what's priceless and for what's profitable, right? And really important. Number two, we know what it feels like to have too much debt, right? In fact, in 2008, we found ourselves flat on our back financially when the market shifted, and I had to get multiple side hustles. I saw clients, friends, and family lose half of all of their wealth in the 2008 crash. And too much debt can lead to a lot of regret, right? And that's where we want to make sure that you don't have significant financial loss because you have a tax flow mindset, a cash flow mindset, and a debt flow mindset. I want to try to help you to think about this in a 3D way versus just a 2D. Most people think of it in like 1D, maybe 2D, 1D being being cash flow, but most people don't even really go beyond that. And so I want to teach you this today. The other thing is over concentrated risk. We want to help you to not have to be overly concentrated with all of your wealth or a majority of your wealth into one property or one asset class and or one business, right? Or just all Bitcoin. And you could say, hey, can I diversify? Can I dollar cost average, right? We want you to be able to sleep really well at night, having certainty of conviction with capital coming in as well as diversification, so you can lower your risk. The next thing is just, if you don't do proper planning, it's 20 to 50% of your wealth erosion. Now, again, this is depending on what state you live in, but not doing planning is not a good plan because upon the exit, you're going to have to pay that tax unless you do proper planning. And number 5 is the failed 1031 exchanges. How many of you have either done a 1031 or know someone that's done a 1031 and they're rushing around, they're overpaying for the property, and I call it the shotgun wedding. It's just like a mad dash, and they wouldn't have bought the property if it wasn't for the tax, and let the tax tail wag the investment dog. We don't want you to ever feel trapped by a 1031 ever again. In fact, we're going to give you the opportunity to eliminate the need for the 1031 exchange forever. And then the really ones that's hitting really hard right now, these client horror stories are people who have bought property and obviously their debt has reset, their insurance has gone through the roof, and their property taxes are higher than they thought it would be. And they don't have enough liquidity. And now they're in a scramble. I mean, they're scrambling every which way. I call it the year of the jujitsu tap out for commercial real estate. People are tapping out and just giving their money, giving their property, giving the keys back to the bank. We don't want you to have any of that, okay? So this is what we've done. We've unlocked a solution that can change everything for you and for your family and for your wealth plan. And we do this by focusing like a laser on capital gains tax solutions. And I say plural because it's, depending on your situation, we might need to use 1, 2, or 3 of the strategies we're talking about today, maybe even more. But we built capital gains tax solutions by helping our business, real estate, and Bitcoin owners exit over $500 million in assets using DSTs, both DSTs, by the way, both a deferred sales trust, Delaware Statutory Trust, and 1031 exchanges. We're one of the few in the entire country who's done all 3, plus has expertise in development, brokerage, structuring deals, especially with the multifamily world. So we have deep understanding of real estate investing, as well as using capital gains tax planning to leverage in a good way the strategies that are legally available. So we've done this for a while now, and through the years of experimentation and thousands of hours of research, we've developed a highly flexible and fully compliant DST solution. And I want to try to shrink the 10,000 hours, and since studying this since 2009 in particular, into this, 30, 40 minutes, however long we have today. Okay. So here's the analogy, or here's the premise. The DST is the bridge to unlock more freedom. Not using a DST, staying where you're at, or just selling and paying the tax reduces your proceeds by 20 to 50%. It also potentially limits your opportunity cost for accessing truly passive income and doubling and tripling your cash on cash return. Give you an example. We had a $2.5 million exit for a seller out of California. Their NOI was about $120,000, and their equity was about, after closing costs, like 2.35, because you have to sell the property. And so you take that 120 divided by 2.35, that gives you a percentage. In fact, I'll do it on my calculator. If you don't have an HP 12C, I encourage you to get one of these, or get a calculator that you can underwrite properties on the spot. So on $2.35 million equity, they had $120,000 of NOI. So I take 120 divided by 2.35. That's a 5.1% cash on cash return. Okay. Now we built a plan where we can increase their cash flow, but to about $190,000 by that same amount, minus a little bit more closing cost. But just think about that. They went from 120 to 190. That is a substantial increase. In fact, one other way to think about it, you take 120 divided by 190, that's going to give it about a 63% increase. 63% increase, right? That's a massive, massive opportunity to get more freedom, more impact, because there's more cash flow coming in. So the DST is that bridge to that freedom, because it enabled them to unlock the capital, defer the tax, but more importantly, be able to put it into other assets, especially outside of California, and also into real estate debt and other investments, dollar cost averaging, that are achieving excess returns. They get more cash flow. Okay. Now, of course, you don't want the shark being the IRS, taking a big bite of the capital gains tax. This is why you want a bridge that's above the water that gets you over there. Okay. So that's the premise. So who is this presentation for? Before we get too deep into this, is it if for you, or if you have clients who have highly appreciated businesses, investment real estate, primary homes, Bitcoin, it could be stock, public or private, or any other asset. Okay. It can really, literally, it can be airplanes, it could be helicopters, it could be racehorses, any asset of any kind. And you're able, and here's the key, it needs to have at least $1 million net proceeds and $1 million gain. Okay. So if it's got to be big enough to qualify. Okay. So all closing costs, net, it has at least $1 million net proceeds. And then it has at least $1 million gain being the difference between basically the sales price and the adjusted basis, right? Gives you your gain. So we need enough gain and really enough pain to be able to qualify for this. Okay. Technically, you can qualify for smaller amounts. In fact, if you have two at $500,000 each that we can combine, we'll look at that and we'll consider that. But I'm just telling you where we know for sure it's a home run, no matter what state you're in, what you're selling. If you have $1 million gain, $1 million net proceeds, and you don't necessarily need or want to spend it all on personal stuff right away. In other words, you could invest it passively, again, with like Sid and Brian. You could go into your own deals if you wanted to, all tax deferred. As long as you're investing the funds, it's tax deferred, right? And so that's a good rule of thumb. So why we built this, right? We built this because, capital gains tax solutions, we built it with capital gains to help our business real estate Bitcoin owners exit, again, over $500 million in assets. And let's see, that might be a repeat slide on accident. We built it to give people freedom and flexibility. It's really what it comes down to be able to steward their capital in a way that's meaningful, that gives them options. It doesn't force them to do something they don't want to do, to diversify, really just be great stewards with their capital. So we exist to unlock capital gains, to multiply freedom and impact. We'll talk about more impact, to be able to give more, right? To causes they believe in. A lot of people want to give more if they had more margin in their cash flow situation, right? So this is what we want to unlock for people. By the way, we have kind of an ecosystem around this whole deferred sales trust implementation. I have about 6 core messages. We're only going to be able to cover about 2 today, but we have much more that we can go deeper on. We call it the Ultimate DST Exit Strategy Blueprint, and it's our collection of these 6 core momentum capital strategies through this overall deferred sales trust that we've used to, again, generate exits over $500 million in less than 10 years. So stay tuned for the end of the call, by the way, for anyone who's part of this. You can get a free, no-cost consultation opportunity to speak with me or one of my team members. If you have $1 million net proceeds, $1 million gain on an asset that you might consider selling in the future, we'll give you a link to that. And so let's start a little bit from the beginning to understand how we got here. My first few years in real estate, I was not Leonardo DiCaprio closing deals. In fact, I was at Marcus & Millichap. I was more like the guy in the back with the cup staring at him, like, how are these guys closing these deals and making all this money? And I was thinking, like, man, I really want to be able to add value. I want to be able to compete in the marketplace. I want to be able to be a broker that can bring something new to the table. And it was difficult, right? And the market crashed, and we went flat on our back financially. So much so that I had an opportunity to work multiple side hustles, 70 hours a week, 6 to 7 days a week, Cheesecake Factory by night and day, and by day I'd work at Marcus & Millichap, negotiating with banks, helping my clients try to get out of their financial struggles that they are in. And so I wear the same tie at Marcus & Millichap that I wear at Cheesecake Factory, and I would serve cheesecake, and that kept the lights on. My wife had our first baby, and so we wanted to keep her home full time. So we whatever it took to keep that lifestyle of my wife staying home full time. And so it wasn't without the struggle, but during this time is when I learned, and who knows that during your most challenging times is typically the places when you grow the most, right? So this most challenging time, I was able to grow tremendously with the resilience and the character and the focus on solving big problems in massive ways. But also I was able to meet somebody, a CPA and a tax return, who taught me about this strategy that ultimately led to the success we have today and being able to transfer some of this knowledge to you. So that's a little bit of the background. And there's the link, by the way, if you actually want to book sooner. So my first question for everyone here today is, who here has felt the pain and frustration of a client or yourself in a panic, in a scramble due to the 1031 exchange? If so, you can put it in the chat. That would be really encouraging for me to know that there's other people other there listening. And if you could also put, what city you're in, or where you're from, that'd be awesome. And if you felt this 1031 shotgun wedding where you're running around with your hair on fire for 45 days to identify, 180 days to close, you're negotiating with the banks, you're trying to do these deals really quickly, and it's not turning out great, right? If you felt that, drop it in the chat. I felt it, or I know someone who's felt it, the 1031 exchange. That is part of what we're going to eliminate right now. So eliminate it. We believe that this is really, really crucial because we've been taught that the 1031 exchange is the end all be all, and it can be a great solution for people, but it's only one. And we call it the blockbuster solution. And we actually believe that eliminating the need for the 1031 exchange, especially if you've made the multiple millions and you're ready to exit and you're ready to get passive, right? You're ready to unlock what's called truly passive income. All of a sudden, it changes the game that you don't have to do a 1031 exchange, or you can have a backup plan in case the 1031 fails. This is what we provide. And so eliminating the need for the 1031 exchange using the strategy that we've perfected, a deferred sales trust, is to your impact for your clients. If you're serving clients as a broker, or even if you're serving as a multifamily operator, syndicator, right? What compounding interest is to your money, right? It literally changes the game to know that you're not bound by the 1031 box. You don't have to show up and return the movie in 3 days. You don't have to worry about if the movie's checked out or not checked in, right? You don't have to worry about that. Remember those DVDs that get scratched and then they're like, it doesn't even work, right? Or you have to, old school, right? The VCR, you'd have to like rewind and it could take like, 7 minutes to rewind the whole thing. Anyways, that's the old Blockbuster days. Never again do you have to worry about that because of what we offer here, right? So we believe that the number one mistake that people make is not solving for themselves or their investors or their clients the capital gains tax problem with a solution that gives them more freedom, or gives you more freedom, less debt, and more time with their families. In fact, back to the Warren and Catherine property sale out in Sacramento, the 2.5 million. The thing behind that sale was they had really toilets, trash, and termites with the property, but they had kids older in life, right? And so they had two twin daughters that were 10 years old, and they found out that 85% of their time is going to be spent with their kids before they're 18, right? Think about that. If you have kids, I have young kids, 6 to 14 and I have five kids, my wife and I do, right? And I'm like, wow, I only have so many years left before they're 18. How do I maximize the impact with my family? How do I maximize the opportunity to travel and to serve in mission trips and to do things that are going to be eternally impacting their lives and generations to come, right? And that's the key. Like, if that's what you're looking for, the 1031 exchange is typically not your friend. And we'll talk about why the Delaware is not your friend either for that, because they do offer passivity with the Delaware, but they're very low returns typically. So we're going to give you a solution that gives you higher returns and flexibility to be an entrepreneur or to be passive, to be retired or be active, to do either or. And this is the neat part. Warren and Catherine's plan is once the kids are over 18, they're going to go back to being an entrepreneur again. So we don't want to take that away from you. You have a drive and a passion for building business, for building real estate. Like, don't take that away. Just know what season of life you're in and use a capital gains tax solution that gives you that freedom and flexibility to be where you are today and where you want to be. Okay. So that's the number one mistake. Here's some other client success stories. $17 million deal in Sacramento for a billboard exit sale for Jeff. Dharma, we did over 737 million in exits in Texas for a lot of like land contract flips. David Sloan, he's actually a multifamily operator, syndicator, over 120 million, 6 different exits for David. Another client, Shay, who did the Alabama business exit. These are all entrepreneurial, very, very driven amazing, successful people. So I share this because this is not just for someone who wants to be passive and retired, although it's great for that. We really serve purpose-driven entrepreneurs and investors, okay, who want to be passive or active. You're not set in a box. This is part of why we're not big fans of the Delaware Statutory Trust, is because it literally takes away all of the control, all of the liquidity, all of the diversification, and you're stuck in a box for 7 to 10 years, making about 5% on your money. Not that exciting, right? Not that exciting. That's where the Delaware statutory trusts typically are. So not great, although we do use those sometimes as well. I appreciate Mary saying you're from California, Tony from McKinney. I'm not sure where McKinney is, but maybe you put the state there. My geography is maybe a little bit off. Maybe it's Texas.
It's
Um,
Texas.
is it? Okay, cool. Texas. All right. That's good. And then, yes. And so Eddie asked the question. So for appreciated properties with less than $1 million unrealized gain and $1 million cash proceeds, the 1030 DST are ways to go. It depends, Eddie, right? What are you trying to achieve? We might do a partial, with Trump tax plan coming in here with the 100% bonus depreciation. Sid and Brian might have an opportunity where you can get some accelerated depreciation. It depends on their fund model, or it depends on their syndication model, but that could be a way to do it, right? Where you have maybe $300,000 of gain and maybe $100,000 of tax, and you might be able to put two or 300,000 of equity into a passive multifamily deal and be able to offset that. So we're looking for low hanging fruit on that. Like if we don't have to do the complexities of what we're talking about, that's great. But generally speaking, this needs to be big enough, right? Big enough. And again, a 1031 can work for any size deal. And if the deal makes sense to invest into it, then that's great too, right? We're not saying it's not. We're just seeing more and more clients want liquidity, diversification, be out of debt, whereas the 1031 keeps you in debt. So if you have debt to replace, okay? All right, so keep going here. So how does this whole thing work? Brian, are you ready to participate? Because we're going to walk through this thing and teach everyone right now.
I'm always ready.
Okay, so simply, Brian, here we go, right? Let's imagine you had a $10 million deal. We'll put it in Houston, Texas, okay? And you've owned this multifamily property for 27 and a half years. You've fully depreciated this thing, right? You have no debt to keep it simple. Now, in the state of Texas, you have zero cap gains tax, which congratulations, Brian. The state of Texas is great for that. But you have 20% federal and 3.8 Obamacare. And you have some depreciation recapture. So we're actually going to throw this thing to about 28%. Okay. And that's just a rough number, 20, maybe 26. Okay. So if you were to sell today directly to the cash buyer, Brian, you would pay about 2.6 million in tax. You see that, about 26%?
Mm-hmm.
Okay, so that's what we're trying to solve for. That's if you sell directly to the cash buyer. Instead, Brian, if you did a seller carryback, Brian, are you open to carrying back paper?
Sure.
Okay. Now, here's what we're going to ask, Brian. We're going to ask you to first sell it to the trust and immediately sell it to the cash buyer. So it's a simultaneous close. Okay. We're going to get the buyer to come up with 10 million of cash or financing. We don't care. We're not going to finance him or her. Simply, though, we're going to ask them to cooperate. And this is what's going to happen, Brian. You're going to sell your assets to the trust for 10 million. Okay. So that's step one. You see assets to sell right here to the trust. Okay. Now the trust is immediately going to sell it to the cash buyer. And the cash buyer is going to get $10 million into the trust. Okay, we'll make this thing here, right? See this thing go boom, sell it to there, right? And trust is gonna sell it here. So here's the key, Brian. If you and the 10 million hits the trust, okay, let's say that's all net of closing costs, no debt. So Brian, here's the key. If you received 0 at closing, and this is Brian, look how good looking he is up here, right? Beautiful wife and family. Yeah, he's looking great. Okay, but Brian, if you receive 0 at closing, how much tax is triggered on 0 at closing?
I hope it's a big fat zero.
You got it, right? Now, if you got a promissory note for 10 million, and let's just say we wrote the interest rate at 9%, we're going to write a note for that, right? Okay, so you're owed 10 million, and this is $900,000 per year in interest, right? Mm-hmm. But again, this first year you received 0, and you didn't get, and we invested the money, so how much are you going to pay on 0 if you've taken 0 in the first year?
0.
Okay, and so now at the end of year 1, it is, guess what? $10,900,000. Okay. Now this is really cool because Brian's like, I'm making some real solid cash income right now. I've got a pretty high income. I just kind of want to shelter some of this income tax. So Brett, are you saying that we can shelter the $900,000? Yes, at least for 2 years. Okay. So in fact, this would be more than 10.9, um, because it'd be compounding effect here. But this is something I want to point out. Okay, there's a compounding effect of the income as well that you can defer for at least 2 years. But back to what's happening here, because Brian, you're doing an installment sale. Do you see how until you take actual constructive receipt, you're not paying any tax?
Correct.
Okay. So the trust issues a promissory note. That's the key. So, Brian, you have become a lender. It's the Bank of Brian.
Mm-hmm.
Okay. And you married Brian?
Yep.
Okay. So it's the Bank of Brian. And what's your wife's name?
Marianne.
Marianne. All right. It's Bank of Brian and Marianne. Okay.
It's
So
Bank of Marianne, let's be real, but okay.
okay. All right. Yeah, I hear you. I hear you. And she lets you operate it, right? So
That's
that's
right.
cool. And yeah, that's well said. So this is the key, right? This is owed to you guys, right? Now, this trust, by the way, only does business with you and your wife, Marianne. Okay. Doesn't do business with anybody else. Nothing moves without your approval or your signature. Okay. You get to decide how and where you want to invest the funds. You can put it into stocks, bonds, mutual funds, Bitcoin. You can put it into your real estate fund of your own or with others. It's syndications. It can go right into Reg D funds, no problem. We're seeing a lot of real estate debt between, double-digit returns right now, which is pretty attractive for a lot of folks. Now I'm this trustee. This is me. Okay, everybody, right? If you haven't noticed that, that's me. So we're a third-party, unrelated trustee. So you work with us and our team to execute this. You've sold and you have given up some control, just like if you've ever done a 1031, Brian, you got to get up some control, right, for that 45 to 180.
Yep.
But guess what? Nothing can happen without your approval or your signature because you're the secured lender that's owed this 10 million plus $900,000 per year compounding. So I'm going to pause there, Brian. Let's see if you can just explain this. This will determine how smart or how clearly I said this and maybe how smart I am. Walk us through what just happened. Say it one time. Let's make sure you got it.
Yeah, luckily I'm gonna do my best. I've heard this before. So essentially, normally, a transaction happens at arm's length. You have a buyer and a seller. Property goes from buyer to seller,
Yeah.
easy. In this situation, there's essentially someone in the middle, and that someone in the middle is the trust that gets set up. It's managed by a third party, which is your company. You're the trustee, right? And we are
Perfect.
selling the asset to the trust, and then the trust is selling the asset to the buyer. And
Perfect.
because of that, the proceeds are not going from the buyer to the seller. The proceeds are going from the buyer to the trust. And
Yes.
because the trust is getting paid and I'm not personally getting paid, or my
Yeah.
LLC is not personally getting paid,
Right.
there's no tax event that is happening in that situation. It is all being deferred at that point until either the trust is dissolved or some sort of other situation can happen. Yep. And because there's now money in that account, we are essentially doing a note, as you mentioned, and I'm sure the interest rate can go up or down, and you can kind of set it up as flexible as you want. But I am getting paid 9% on that $10 million. And we haven't talked about this yet, but you can also leverage, the money that's in the account up until a certain point. So I don't want to get too far ahead, but
Damn, I might as well just hire Brian. Everyone mic drop for Brian. He literally nailed it. There's a couple little slight things I want to make sure we point out. The interest rate is a fixed amount up front. We set that, but it could be as low as 5. It could be as high as like 10. We've even done a couple at 12, depending on your risk tolerance. And so you say, how do we determine the interest rate? Based upon a risk tolerance questionnaire, right? And kind of a general, like, where and how we're going to invest the funds. And we want to try to match up the suitability with the investments, with the interest and the risk. So there's all that piece there, but you don't have to take the full 9%. Even when you start taking payments, you can take partial interest payments. So you can take like 6% and let the other 3 accrue. Right. And you can adjust the payment higher or lower. Okay. It can, the interest rate, the payment can be adjusted higher or lower. The interest rate is going to stay fixed for the term of the 10-year term. Typically it's a 10-year term. Every 10 years, you can renew for 10 years, renew, pass it to kids. Kids can step into your shoes, not a stepped up basis, step into your shoes because it's a promissory note. But yeah, you're nailing in all of those things. And someone might say, well, then why isn't the trust pay tax? And I say, it's a great question. Okay. So the trust, check it out, Brian. If the trust bought your property for 10 million and sold it for 10 million, how much tax is, how much gain is on 10 million and 10 million?
Yeah, zero.
Zero, right? So the trust has no tax. Now the trust can also interest. If you say, well, why doesn't the trust pay tax on the 9%, right, on the 10 million on its tax return? Because the trust files its own tax return. Well, because the trust can expense the interest of what it owes to you, even if it hasn't paid you. So the trust year in and year out typically operates at a paper loss,
Mm.
okay, for its tax return. Okay. So that's big, right? That's really big. And so you might have zero basis on that 10 million. And you might be making 500,000 on that, right? You probably not even making 9% on that. So not only do you go from a situation where you were paying ordinary income tax on that 500,000 because you had no depreciation left, but then you turn around and that 900 can be deferred, right? And earning bigger, and you may only take 250 or 500 or whatever amount you want to take, right? That's the point. You pay taxes on that. Here's the next best part. You ready? You can partner with the trust. And this is, you kind of mentioned this. It's called a JV LLC. Okay. And this trust can take the 10 million, and let's just keep it simple. Let's just say it takes 3 million for right now of the 10, and it puts into this LLC. Brian, we make you the managing member, and we give you a large percentage of this, about 80%.
Mm-hmm.
But the trust puts up all of the capital. It's basically a passive LP. It's a JV, so it's not technically LP. It's a joint venture partner, but it's a passive partner, right? Brian, you're doing all the sweat equity. You're going back into your own deals, your own
Mm-hmm.
fund. And guess what? What does a new LLC have?
Depreciation.
A new depreciation schedule.
Yep.
Okay. So let's say you took 3 million here and you bought a 30% down, you bought a $10 million property.
Mm-hmm.
Okay. This is a new depreciation schedule here on this 10 million. So at this point, your brain should explode to say, wow, you're saying, Brett, we took a zero depreciation, and not only do we increase Brian's cash flow, diversify his wealth, give him the ability to have income or slow down the income, but then he can literally the next day set up an LLC, put 3 million from the trust, all tax deferred, by the way. This is all tax deferred. This is not a distribution. This is tax deferred. Yes. And he goes and buys his 10 million. Now he's 80%, so we can't give you the full depreciation. We got to keep it commercially reasonable. The trust is still at 20%, and the trust has a pref return. We have it set up precisely for this whole thing. But this is the super cool part, because Brian can still be an entrepreneur, which he is, right? He doesn't want to just to be in a box, but he could also be, Brian meets me 30 years from now and he's like, Brett, I'm just ready to be passive. Sid's got this whole thing under control. Let's just roll it and let's just move it into the fun. Let's diversify. Brian, any questions or thoughts on that piece right there?
No, I think that's arguably the most powerful part, because the first thing I thought when I first saw this, it all makes sense, all makes sense, great, great, great. It's like, I don't want my $10 million locked up for 10 years. It's like, no,
Right.
your 10 million isn't locked, even though you're making 9% or whatever the number is. Maybe it's a million,
Yeah.
maybe it's 5 million. You're actually, and we're all, I would argue most people that have, or a lot of people that are leveraging this tool are entrepreneurs, real estate
Yeah.
investors, business owners,
Right.
that they want to go out and do more deals. Even when you're old and quote retired, you just have the bug. So you want to be able to leverage it for different
Yeah.
opportunities. And I think that is the best part. And that's also too, comparing it to a 1031, and a 1031 is great in a lot of examples, but that's where it also becomes more powerful, is the lack of restrictions that you get. You're not worried about the 45 days and sort of this other stuff. And then the list of
Mhm.
things you can and can't do.
100%. You nailed it, right? And by the way, it could be up to 8 million. It doesn't have to be 3. In
Mm-hmm.
fact, we like to keep a general rule of thumb is like keep about 20% and like some liquid diversified. And by the way, it can be like short-term debt. We have some debt funds at 10%. Brian may have some stuff there too, where it's like semi-liquid, like 30, 60, 90-day liquid kind of thing.
Mm-hmm.
So for those that are excited about the stock market, you don't have to go into the stock market, but you can as well. And we can put it secure against the biggest companies in the world. We had that one owner who sold the $17 million business in California. A lot of it went into NVIDIA. And NVIDIA, this is like 3 years ago. And obviously you've seen what the stock's gone in the last 3 years. So, and he could sell that stock and go back into more business ventures. And so it's like, it's like sell high and buy low when it makes sense, be entrepreneur or be passive when it makes sense, maybe do a little bit of both. That's the point. Diversify, liquidity, get out of debt. This is why it's Netflix and transformational versus just Blockbuster. Okay, so we're going to keep rocking and rolling here. In fact, wow, this is a great slide to have this on. Okay. Blockbuster is the 1031. And what we have is like Netflix. I think you're kind of getting a feel for what that means. You can get a lot of freedom, a lot of opportunity, and hopefully, yes, have more margin so you can give more to the causes you believe in right now, not have to wait to give or wait to get a stepped up basis for kids. So ultimately, we created this because your clients or you deserve a better way to exit. Guess who doesn't want you to know about this stuff, Brian, and everyone listening? The real estate broker world, they don't want you to know about it. The 1031 world, they don't want you to know about it. They want, it's kind of like, wealth without Wall Street. What does Wall Street want to keep you in? All of the Wall Street products. What is a 1031 world? And by the way, I love a 1031. I'm a California real estate broker. Like I'm speaking and this is nothing against anything of brokers. They don't know or they don't want to know. Right? They don't know or they don't want to know, or they haven't seen their clients go through the pain of losing half or all of their wealth. And so, but this is the kind of thing, once you see it, you can't unsee it. Right. And you're like, oh my gosh, yes, I see it now. And so they don't want you to know about this. Now, all of them know, but a lot of them just don't. They're only going to get paid on what they get paid on. So just realize that when you try to go back to the the people that you've been working with, we're not going to say don't work with them. We just say just bring them onto a call with us. Let us walk them through it. Don't feel like you have to do the heavy lift for your CPA or for your real estate professional or whoever it is that's going to be the skeptic to say, oh, I don't know about that. Say, come on with Brett, bring your objections and thoughts. We work on a conditional basis and we promise to never talk you into anything we don't think it's a good fit, right? And if you ever feel like it's not a good fit, you just let us know. We're we work on a 100% conditional basis. So that's just, I just want to throw that out there to keep everyone's at ease on that, okay? So, all right. So here's another live case study deal. Nick and Jeannie, they sold a business and real estate, literally net proceeds about $7.298 million. And they went with a really reputable group on the right here, who you might know about. And I say 30 to 100% more because if they wouldn't have sold it without us. So literally the real estate fund group would have got 0%. Right? Or they would have sold, pay all the tax, and they would have only showed up with 70%. So I say 30 to 100% more. So if you're in Brian's world and you're like, you do syndications or you do funds and you're looking to, we call this unlock the capital versus raise the capital. Solve the problem by adding value to the seller now so that the bridge can just come over. Okay, so this is you can watch this entire show, entire podcast on my YouTube channel. Okay, for Nick and Jeannie. Okay, and also the other ones too. I think they're all maybe one are on my YouTube channel. Capital Gains Tax Solutions YouTube channel, Build as Billions. Okay, all right. So type of assets. I want to remind you, this works for businesses. It can be any asset of any kind: LLC, S corp, C corp, stock, or asset sales. It can work for partnerships. Each partner can have their own trust set up. We did a $13 million deal in San Diego. We had 3 partners do all their own trust. The one of them just pay their tax. Very flexible. All separated, not commingled, never commingled. Of course, works for real estate. We do primary homes, luxury real estate, especially. I did an $8.3 million deal in Palo Alto, tons of real estate, multifamily properties, mobile home parks, office buildings, Bitcoin. We're the first to ever do this with Bitcoin. Okay. We had a client bought Bitcoin for 50,000, went to 50 million at 54,000 a coin. She had never sold until she met us. We exited that 5 million of it. She was able to invest it into a Khan Academy kind of educational thing for impact. That was her impact, right? She unlocked the Bitcoin that was, not doing anything for the world, for what she was looking to do for the world. And now she was able to do that. And Bitcoin went from 54,000 to 68, and then it dropped to 15,000 a coin. Now I think we're at 107 today. But the point is, she could sell high and diversify. We've also done with other cryptocurrency. He also works for public or private stock, okay? Car dealerships, tech entrepreneurs, collectibles, healthcare professionals, dentists, optometrists, veterinarians, you name it. Like literally thousands of transactions have happened close to 30 years now, okay? So land entitlement without even holding it for more than a year, okay? We can do it for short term, less than a year if it's a big enough deal and it's a one size check, right? So some of the land deals that we've done, I talked about, we've done those, okay? All right, keep going here. All right, so here's some free resources, all right? So take your phones out, scan these resources. Literally, I'm giving you like the treasure chest here. 50 top questions you should ask to get started on your capital gains tax exit plan. I've got case studies for clients. We've got the kind of like I call it like a 2 or 3 pager. It's just kind of the essentials, the details. We have that graph of how this thing works. We have our kind of our brochure. We have a 1-pager for our best 1031 exit plan and a 1-pager for this. We have our perfect, truly passive income wealth flywheel to help you build this out. So these are all because you attended this. Please take advantage of that. All right, scan that. I'll give you another 5 seconds to scan that QR to get access to that. All right, moving right along. Okay, what's the cost of all this thing, bro? This must be so expensive. Well, I want to teach you how to make the DST an investment and not an expense. Okay. First of all, one-time fee is the legal fee, 1.5% on the gross sales price on anything above a million, and then 1.25, I'm sorry, anything below a million, then 1.25 on anything above. Okay. So if it was $1 million deal, 15K. If it was 2 million, it'd be 15K on the first million and then 12,500 on the second million. Okay. So that's a one-time lifetime audit defense, conditional, only paid at closing. Really important to understand. We take all the pressure off there. What's the annual fee? The annual fee is to us, the trustee, it's about 1.5% to 2% on the net proceeds. So after closing costs, after commissions that you're paying, legal costs, whatever net debt you're paying off, that is how we make our money here at Capital Gains Tax Solutions. Here's the key though. We cash flow our fees. We wait about 60 days to cash flow. So our goal is to work with people like Brian and Sid and their group and cash flow the money and cash flow. I'm sorry, invest the proceeds, get the cash flow coming off of it to pay it. And so our goal is to not dip into principal ever, to pay you and to pay us and to keep it to compounding. And then there's like an annual trust tax return, about 1650. It's like a C corp tax return. It's pretty advanced, you know, more advanced than you might think it is. P&L accounting team. This is important. We have a third party group do all of this. So they're kind of like an auditor of it all. They're looking for any discrepancies and they're making sure everything lines up. And so that's another set of eyes and ears. We typically return 7, 8, 9, 10% compounding net of the recurring fees, including the annual trust tax return fee and our annual trustee fee. Okay. All right. So how to make the DST an investment and not an expense. First of all, we talked about capital gains tax deferral, so you have 20 to 50% more. Number two, remember this year-over-year tax optimization. This one's the one that's most overlooked. It's compounding net income tax deferral. This is massive. So if you have IRAs or 401ks, you may or may not know this, but all of the dividends, all of the cash flow, all of the capital gains tax is all deferring and compounding. That's really important. Outside of a tax advantaged plan, you're having to pay tax on those dividends, having to pay tax on that tax, the cash flow if you don't have depreciation. So we can do that with the trust. Now we do have to take some payment. We can't just delay all of the income, but we only have to take like half of the interest, starting at about year 2 or 3. We already talked about the new depreciation schedule, so we'll just keep going on that one. We typically 2 to 3x cash on cash returns. It just depends on your ROE, which in and of itself is just a game changer. This is part of why we don't go into the Delawares very often, because a lot of times it's about a 5% cash on cash return. You're like, this isn't that great. You're like, yeah, why would you do it? Right. Whereas us, we're double digit returns. And that's what unlocks transformation for families. In fact, we call it your truly passive income number, right? So we think that truly passive income is to your freedom and impact as compounding interest is to your money. Is it 10, 20, 30, 40, 50,000 per month? Line it up like a laser, what that amount is, and then do everything you can to get that coming in passively. And what I mean passively, I mean no shoes, no shirt, no problem. You're Kenny Chesney on the beach playing on the guitar, and you have your glasses, you have your hat on, and you don't think about anything in the world, and this passive money shows up. No toilets, no trash, no termites, no business, having to work a business. You just truly are passive. That's a big piece of this. And let's keep wrapping it up here. We're almost done. Oh, estate tax. If you have estates above 28 million married or 14 million single, you need to be aware that the stepped up basis is not solved for the death tax. Okay. We'll cover that here in a second. Who here's seen Stranger Things? Hopefully you have. If you haven't, please watch it. It's a great show. It's great. All right. So this is Elle. She's talking about friends don't let friends, like she's like friends don't lie to friends kind of thing, right? So we believe that friends don't let friends overpay in a 1031 exchange. So you want to make sure we encourage you to share this information with somebody who can change their life. Please don't keep it to yourself. I did promise I would talk about the difference. Here's with the Delaware. Okay. So real quick, deferred sales trust works for any asset, any kind, anytime. So any asset that's selling, it can invest into any kind of asset, and there's no timing restrictions. So Brian, would you like to have any asset, any kind, at any time, or Delaware Statutory Trust, only investment real estate, no control, no liquidity, no diversification?
I'll take the deferred sales trust all day.
Yeah. And by the way, if you really like the Delaware deal, they're like, they just got this really great student housing deal or this really great, thing. Cool. Let's go into the deferred sales trust for your $3 or $5 million and let's put $100K into their Delaware deal. You don't need a 1031 all of your money into that. Why would you do that? Right? Or else put 250, whatever amount you want. Like you can still go into their deal. Just do it through our way. In fact, you do it through an LLC, we can set a new depreciation schedule on that too. Right? So like there's some cool things here like that. Like, so by the way, sometimes we do half and half, right? When we have debt over basis issues. Okay. So this is important, right? How do you handle which one to choose, which one to choose, which one to choose, right? So 1031 exchange, the benefits clients. Here's one of the coolest things about a 1031 exchange. You maintain a stepped up basis. I don't want to ever downplay that. That's an incredible thing. Okay. And you maintain the tax compounding benefits when you're 1031. Okay. But sometimes you're in the middle, right? You might want to do a partial 1031, or you find, you sell a $5 million or $10 million asset and you find a perfect $3 million deal, but you got 7 million to boot. Well, we can do a partial 3 million 1031 with us and then do the other 7 million. Right. This also gives you the ability to negotiate great deals versus I really like the $3 million deal, but I need to spend 10. So I got to go for the 10. And you end up settling for the B property versus the A property. Right. So we want to give you time to negotiate, to leverage. The worst is when the sellers say, we got you right where you want you, and you must buy this property. We know because you're in a 1031, and they don't negotiate. And instead you could say, we have a backup plan and we can negotiate. Okay. So that's really important. And the last one is you can use the DST before the exit. So you don't even need to use a 1031 at all. If you have no debt over basis, we can set this up and you literally just eliminate it altogether. Okay. So that's that. By the way, if you want to get more information, go to brettswartz.com or even capitalgainstaxsolution.com. We have what's called the best 1031 exit plan. Please, for all of your 1031s, come only to us. We will help you with a regular 1031. We got the best of the best to do that. We will help you with the Delaware Statutory Trust, and we will help you with the Deferred Sales Trust, and we might even do all three in one transaction depending on your unique fact pattern. Really important that you don't go with just the people who only know a 1031, because guess what? They can't help you with the other two, or maybe they only know two, but they don't know the third one. Okay. All right. And by the way, if you want to learn the top 3 mistakes in a 1031 exchange, why don't you just scan that QR code and you will, it'll connect me on my Instagram, and then send me the word in a DM unlock, and I will send you the top 3 mistakes in a 1031 exchange. You can't afford not to see this to make sure that you don't get caught in a terrible 1031. All right. So go ahead, give you another 5 seconds to scan that. And here we go. Okay. All right. Who here has seen Yellowstone? Brian, have you seen it yet?
I think a long time ago.
Okay. So here's the premise. Okay. Spoiler alert. They have this land in Montana. It's worth $1 billion or something, right? And Beth's like, Dad, we got to sell the land. And Kevin Costner goes, Beth, we're never selling the land. She goes, but Dad, if we don't sell the land, they're going to kill you. Beth, we're not selling the land. He goes, but Dad, if they kill you, let them kill me. If they kill you, the death tax is going to kick in and they're going to take the land anyways. I'm never selling the land. At this point, I'm like, Kevin, use the DST 2.0. We'll eliminate your estate tax. Now, he would have to have sold the land during his lifetime, right? And we would eliminate the $1 billion outside of his taxable estate. No life insurance, no gifting, no charity required. Okay, this is massive. And so if you have a net worth basically above 30 million married or 14 million single, you've got to take notes on this, because you're really solving for something on a higher level than cap gains tax. You're solving for the death tax. Okay, so very important. All right, so unraveling the estate tax dilemma. First of all, without proper planning, the family legacy is at stake as far as wealth legacy, the loss of heritage, and like just the financial acumen here, right? The forced sale within 6 months of the death. Okay. The emotional stress, the family conflict, the pressure of decisions, post-close, post-death. It's going to be really, really, really frustrating. Limited planning options once you die. The appraisal costs, the tax, again, 40% above the exclusion amounts. The urgent deadline, we talked about the time constraints. Really, it's just all of it adds up to emotional and financial toil of a state. It's a terrible way to have the family having to pick up the pieces, but a lot of people still know the answer to the estate tax, but we have that solution. So we can use a 2.0 to literally erase estate tax. Okay. One sale, one day, all at once. We can eliminate the death tax. No charity needed. No life insurance required. no gifting necessary. It totally simplifies your estate. Your children can be the beneficiaries here. Okay. Now here's some of the cons. There's some planning involved. There's some fees involved, right? Third party trustee, that's us. It requires the professional guidance. You probably you don't know about this maybe at all, and your CPAs probably don't know about it either, though they would have provided it for you. And there's the ongoing cost, right? But we want to educate them. That's why we work on a conditional basis. This is just real quick a graph, okay? So if you're worth these net worth amounts per individual, those are the exemption amounts. And so if you're worth 14 million single, and then you have nothing to worry about the death tax at this point. If you're worth 28 million married, you have nothing to worry about at this point. But if you're worth more than that, or you think you're gonna be worth more than that, then we need to solve for that. We need to be thinking about this, okay? And by the way, in 2026, it's set to cut in half outside of any other changes in the government here. All right, so this is it. We're wrapping up. Do you want me to help you, either help your clients or help you as the investor? That's really the question. And no worries if not, no problem. But if you would like me to help you, please, I will encourage you to this is how we can work together, okay? We can have a one-on-one consultation with myself or one of my team members. We can book, if you have a podcast or anything else, if you're like someone like Brian in a webinar, you can book me on a podcast or a webinar. I do speak at certain conferences as well. I can do a blog post contribution to some things. Real quick about myself. This is my wife and Melanie and I and our 5 children. And we live here in St. Augustine, Florida now, although we have team members in Texas, Dallas, and also in Sacramento, California. I'm the host of the Build It to Billions podcast and Capital Gains Tax Solutions podcast. And then I have a book called Building a Capital Gains Tax Exit Plan that you can pick up on Amazon. If you want to hear my entire story, we have Kevin Harrington from Shark Tank in the book. So that's a little bit more about me. And then again, that's the book right there. You can scan that QR code if you want to. I think that'll take you to the book if you want to do that. And this is the free consultation call. So if you want to do something right now, just get that QR code right there, scan it, schedule a time when myself or my team member will be 30 minutes to strategize. Totally no pressure, we call it the pressure-free consultation. You can just jump on and we can just chat through some strategy. And I'm going to just finish with this, okay? And I want to encourage everyone to remember, don't trade what's priceless for what's profitable. This is Warren and Catherine. These are clients of mine. You can watch their entire podcast interview on my YouTube channels. And you go to Client Success Stories on my Capital Gains Tax Solutions playlist. And they had these 2 twin daughters. About 10 years old when they sold the property. I think they're about, 7 or so when they took this picture. And Warren was driving multiple hours back and forth in traffic to the property. And he was like, man, I feel like I'm really trading what's priceless for what's profitable. If there was a way to sell this, defer the tax, and get a truly passive income plan, it could change our life. And that's exactly what he did. Now, did he have some fear and some concern and not sure and all of the things that you might be considering right now or feeling? Yes. Did he have a CPA look at it? Yeah. Did we work through it? Yes. Did they take a step with us? They did. And it literally transformed their life. I'll never forget what Warren said to me. He said, Brett, it's like the weight of my shoulders lifted off about 3 to 6 months into it. He's like, all of a sudden, I just felt like I had no more pressure with that property anymore. And I had diversification and I had liquidity and I had passive income. And he goes, it just changed our life. Okay. And that's what we want to do and help you to do. With that being said, I'll pass it back to Brian. Any questions and we can wrap it up.
Oh, this is awesome, Brad. I think the big thing I took away from this is there's, it's not black and white and everyone's situation is a little bit different. And there's also a lot, what I think was surprising to me the first time I hear this, and maybe some LPs are here thinking like, oh, maybe this doesn't apply to me. Maybe it does. Is there's a lot of creativity and flexibility that can happen around these different methods, and everyone's situation's different, which is why it's important to get on a call and figure out and kind of talk through with the experts, because what applies to me might be different than what applies to you. Some people are at different stages in life. Some people are got their estate already planned and things are already in writing with attorneys and stuff, and throwing this in can change things that might need modifications. And some people are not there yet, but they're working towards it. So I think the beautiful thing about this is the amount of flexibility you get. And it was just an eye opener to me that you could do so many crazy things like the partial 1031. I had never heard of that before. And the DST, there's two different ones. That was a
Yeah.
new thing for me as well. And then just the power of having the flexibility and diversification option, I think is super cool. So hopefully it was very educational. We do have a question that came in early. It says, my question from Christian is how to get out of large real estate holdings. He's rental homes and syndications, get the most cash out and minimize my tax bite. After all, my kids don't want the properties and I just want the cash and maybe buy a big boat.
Mhm.
So I guess he's asking what would you recommend as far as like how to get out of large real estate? Let's say he has a large single family portfolio or a bunch of
Yeah.
syndications. How does he get the most cash out and minimize his tax bite?
Yeah, it all depends on a couple of things. First thing is we need to do an analysis on, estimated sales price of the asset, the estimated debt on each asset, and the estimated adjusted basis. So you want to create a spreadsheet for all your properties or all your holdings and basically create those three columns. What if I were to sell it today? What's it worth? What's the debt that it's on it? If there's any or no debt, just put zero. And then what's my adjusted basis? Based upon that, we can do an analysis on what the capital gains tax liability would be if you were to exit. Now, I'd also check this with your CPA to find out if you have any carry forward loss, potential losses from the past that you could carry forward to offset some of these taxes, right? That's a kind of a low hanging fruit one. And then we just start, just do one bite of an apple, right? So how do you do it? One bite at a time. We start with the first property and say, okay, what's this property worth? What's the basis? What's the debt? What's the tax? Is that a good fit for the trust, right? And then work our way down the entire list, and then you start with especially the ones that are low hanging fruit. Like I don't like the property as much anymore. I have massive appreciation, and I've kept the rents low, and I just because I don't really want to think about it. Well, that sounds like a great one to sell, right? You can harvest that gain. So let's start with the low hanging fruit and just work our way into the trust. The trust can take on as many properties and many assets in one trust and get multiple promissory notes, right? Now, when I hear single family homes, I also want to caution with you, like I've had people call me that I got 40 single family homes and the average it's 150,000 to 250,000. I'm like, it's not going to fit, right? Unless you're going to sell it as a portfolio bulk and you happen to have one LLC that owns all of the assets, then we can probably squeeze it and it all adds up to 3 or 4 million bucks. But when you have individual properties, all different individual LLCs or individual names, and it's not greater than the million, then it's not great because of the cost. So I don't know your situation for sure. Your properties could be worth 500,000 each, right? And so now we're in a different ball game there, right? So I guess he can unmute if you want to talk through it, or he can schedule a time with me.
Yeah, I'll get him a scheduled time. I think I actually see this quite often, Brett. We talk to some investors. I know I do, and anybody can watch this recording. We can talk. Just fast forward to this part. Is I talk to investors very commonly that are in retirement. Maybe they're mid 60s, early 70s. They've got 15, 20 houses.
Yeah.
Pretty much all of them are paid off, if not all of them. Kind of the exact situation you just mentioned. And what I see them doing is selling them, one at a time, one at a time, one at a time, taking the profit, putting it in a syndication, right? Something like that,
Mm-hmm.
right? These
Mm-hmm.
homes here in, let's just say here in Houston, the average home is selling for probably around 300,000, just like a
Mm-hmm.
rental home,
Mm-hmm.
so 10 homes, 300,000 a pop, you might have $3 million,
Mm-hmm.
plus or minus, right? And close to that basis. So to me, connecting with somebody on your team and finding if you're thinking about doing that and you haven't even started, what could you creatively do now to potentially avoid paying capital gains taxes on properties you own free and clear for the last 10, 20 years, versus selling them one at a time. How can we strategically roll this together so you essentially stick more money in your pocket? And if you are near retirement, you're thinking about death and all that, how do you set it up in a way so that your family, your kids, or whoever can step in, as you mentioned, and take over?
Yeah. Yeah. All of the above. And then I also Christian, I just encouragement for you, like figure out what matters to you the most. Right. And if I'm just reading between the lines, it's probably no more headaches, no more toilets, no more trash, no more liability. And then simply getting truly passive income. Like this is 9 out of 10 people. Right. And so if that matters to you the most, a lot of things matter, but I feel like too many times we want 5 or 10 things, and really all it really matters is one or two, the top two, right? So like what matters to you the most, and then like a laser, just knock those two things down. And if you knock those two things down, the rest of it usually goes away. Like it didn't really matter anyways. So that's what I would say. Just get really clear on that. Get really clear on your truly passive income number. And then yeah, schedule a call. Let's talk for 30 minutes. Let's just see if it could, potentially be a fit for what we provide.
Yeah. The other thing I see, Brad, that I had a question about that I think might be insightful for some people is we also, one of our big investor base is business owners. And I often talk to business owners that have some sort of exit coming up or some
Hmm.
sort of partial exit. And everyone's situation is always a little bit complicated. It's never a
Hmm.
clean, it's rarely a clean, like, somebody's buying it, they own 100%. Sometimes there might be some owner financing. There might be some sort of, payback over a 3 or 5 year period. What do you guys typically see, or what do you recommend for anybody who has a large exit coming up? They plan on netting more than $1 million in profit for a,
Yeah.
a business sale. What sort of step one to get on the call with you and get the process rolling there?
Yeah, so business sales are like the lowest hanging fruit because there is no 1031 option, especially, and,
Mhm.
and also to typically a business owner wants to get into real estate or wants to start another business when they're selling. And so we're perfect for that. So the answer is be early. Like the earlier the better. Don't wait because it's no cost, no obligation. If you don't use it, no worries, right? But what we found is like the larger the deal, the more the M&A advisors and attorneys
Yep.
have the stake to push it to closing. And then what kills the deals sometimes is we just run out of time.
Mm.
Like, and the pressure to close just mounts and mounts and mounts. And so we say is build a capital gains tax exit plan before you list or go under contract, ideally. Right. So if you're even considering selling in the next, 3, 6, 12 months, 24 months, just meet with us. Right. We literally can set it up and get it all ready to go and it's ready to go. And then when the M&A attorney comes, you say, hey, just weave this into the contract. And it's simple. Where we get in trouble is they wait, and then they
Mm.
get under contract, and even,
The
we can still
price.
help,
Yeah.
but then it starts getting squeezed, and all of a sudden the attorney's like, "Whoa, where's this new thing coming in out of nowhere?" And you're like, "Well, it's not going to affect you guys, but they, and most of the time we can work it out, but it just no one likes to work under a fire drill, so just be early."
Makes sense. Scares the buyer away too with this,
I don't say it
Yeah.
scares.
Yeah.
They just don't know. They don't know what they don't know. And like when something comes in at the 12th hour, they're like, huh, is there something I need to be concerned about? And again, we walk them through it, and it's actually a good thing for them because if you pay the tax and you didn't do something properly, then there's no real recourse. But if you can defer the tax, you don't do something properly, at least you have an ability to try to pay them back. So it's actually in their favor for the buyer to like want them to do this, right?
Mm. Yep.
But it takes explaining. But yeah, something new can feel, yeah. So that's what I would say. Just be early, and we'll educate everybody. And again, 9 out of 10 times they all, oh, this is great. The MA advisors love it, and they're like, oh, we'll bring our next client to you guys.
Awesome, awesome, love it. Well, Brett, I want to say thank you again for being on the webinar series today.
Yeah.
Tons of information. I know that some people are definitely going to be reaching out to me because I get asked questions all the time about 1031s, and
Mhm.
anytime I have somebody that I think might be of interest to you, I know I always kick them your way. So, if anybody has any questions about this, or they just want, like you said, take advantage of that free consultation, they see something on the horizon and they're not
Yeah.
quite sure about, I definitely encourage them, reach out to you, reach out to your team. This QR codes, I'll make sure contacts information in the webinar replay link that goes out to all of our investors as well. But just wanted to say thanks again. Any final words on how best way for people to get a hold of you? Should they connect with you on LinkedIn, send you an email?
We look like we got something on the get the QR code one more time.
Yep.
So I'm gonna back it up a little bit here. So this is the strategy call one here. So you can scan that. Whoever put that in the QA question answer. But yeah, Brett Swartz, capitalgainstaxsolutions.com or brettswartz.com, either one. Find me on LinkedIn, Instagram, Facebook. And that's a QR code right there to scan to be able to schedule the consultation call.
Awesome, Brett. Well, appreciate it again. Thank you. All
All right, bye everybody.
right, take care.